Firstly, I'd just like to welcome you to this webinar where we'll be talking about the non-farms payroll and unemployment. We'll also be talking about trading strategies that will be of great use to you before, during, and after the publication of the report, which may help to improve your chances of successful trading. My name is Sasha, and I'm a financial analyst from the research department at ForeTrade. I'm really pleased that more and more people are watching our webinars, and thanks for your kind comments. If you have any questions, I will do my best to answer them, or please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. At this point, I'd just like to ask you not to click away until the end of this presentation, as we've got a special offer coming up that will significantly affect your trading experience. I'll also show you what we call a market opportunity in a practical way. As you can see, I'll cover a number of topics related to the NFP. It's one of the most important releases on the economic calendar, and it's what we call a market-moving event. This is why we believe it's important for us to supply you with a thorough amount of quality information. That said, we understand that your time is important to you, so I'll attempt to keep this webinar as clear and brief as possible. If anything is unclear, feel free to either ask, watch this webinar again, or get in touch with your senior account manager. The non-farm payrolls report is the release of data on US jobs growth over the previous month, and it's published by the Bureau of Labor Statistics, usually on the first Friday of the month following the data. It is without any doubt the most eagerly awaited monthly data by world markets. Morning trading volumes are usually slim in European markets on the day of the release, as they await the afternoon release time. The headline number in the report gives the number of jobs, obviously excluding farms, that the US economy has gained or lost over the previous month. A more important number for the markets, however, is the difference between the actual change and the consensus of estimates by analysts and economists published in advance. The market reaction will depend on whether the published figure is above or below the consensus, and by how much. As well as new data, the publication also includes revisions to the previous 2 months. Some revisions are more substantial in either direction, calling into question the wisdom of any significant market reaction based on a single preliminary figure. Fed monetary policy and NFPs. When the NFP is released, the whole forex market moves, and traders see aggressive spikes or dips on all currency pairs. This says much about its importance, so here are some things that will make this release so crucial for forex traders. It all comes from the Federal Reserve's mandate. There is no regular central bank, but it's the most important one in the world, as it sets the interest rate and the monetary policy for the US dollar. As the dollar is the world's reserve currency, the interest rate for it affects all of us. The financial system as we know it is centered on the US dollar. Global financial organizations like the IMF, the International Monetary Fund, and other financial institutions loan money in dollars. Eventually, these dollars need to be paid back. If the interest rate on the dollar is rising, the countries or entities that borrowed when interest rates were low need to pay more to repay their loan. Therefore, what the Fed does with interest rates matters for the whole world, not only for the United States. From this point of view, the Fed is viewed as the world's central bank. The Fed's mandate is a dual one: to keep inflation below or close to 2%, and to create jobs. Jobs are thus looked at closely when deciding to hike interest rates or not. The NFP is the main employment data during a trading month, so it is crucial for the Fed's decision. There are other job indicators or economic news in a trading month, like the initial jobless claims and continuing claims, but none are as important as the NFP number. The NFP release comes together with the unemployment rate indicator on the first Friday of every month. When this is due, the trading week is a range-bound one for the Forex market, and after the release, traders start positioning for the next time the Fed meets to see how the monetary policy changes in the meantime and how to react. The NFP is traded heavily by algorithms, either trading machines, robots, supercomputers that buy and sell hundreds and hundreds of trades per second. And because of that, fake moves are the norm. When the actual number differs from the forecasted one, the market travels. Usually traders try to take positions for the NFP in advance by looking for clues from other economic data, like the ADP jobs report or private payrolls. It is believed that private payrolls and the NFP data are linked in a directly correlated fashion, but this isn't always the case. The unemployment rate is part of the Fed's decision-making process to move on rates too. As a rule of thumb, a lower unemployment rate is better for the economy, as jobs are created, and this will result in the Fed hiking rates. Higher rates lead to a higher dollar, and traders will buy it. There is no such thing as full employment in an economy. By the time the unemployment rate has fallen to below 4%, a labor shortage has already appeared, and experienced traders know this. Forex trading is about anticipating what the central bank is going to do with interest rates at the next meeting. And the NFP is the perfect economic release to position on the right side of the market. After the August the 4th report was published, the US dollar surged against a basket of global currencies, lifted by data showing the US economy created more jobs than expected, while an update from the Trump administration on tax reform lifted sentiment. The US dollar index, which measures the greenback's strength against a trade-weighted basket of 6 major currencies, rose by 0.86 to 93.50. The dollar was on track to record its biggest one-day gain of the year so far, after a strong US non-farm payrolls report eased concerns about a possible slowdown in the economy. The US economy created 209,000 jobs in July, handily beating the consensus estimate of 183,000 jobs. As was widely expected, the jobless rate remained unchanged at 4.3%, while average hourly earnings met expectations, rising 0.3 from the prior month. The increase in wages is being closely monitored by the Federal Reserve for evidence of continuing strength in the labor market and upward pressure on inflation. So, what can we expect from this week's report? Actually, economists expect that August's NFP will show a decrease from July's 209,000 to 185,000, and that the unemployment rate will remain at 4.3%. The Fed raised its benchmark rate in June to a range of between 1% and 1.25%, the fourth increase since the 2008 financial crisis. Rates still remain at a low level that support economic growth, which encourages borrowing and risk-taking. The Fed is gradually reducing those incentives by raising rates because it believes the economy is expanding at roughly the maximum sustainable pace. At July's meeting, the Federal Reserve voted not to raise its key interest rate and said it expected to begin normalizing its $4.5 trillion balance sheet relatively soon. The accompanying statement revealed concerns among policymakers about the recent slowdown in inflation, which remained well below the central bank's target of 2%. Inflation data has undershot market expectations for 4 straight months now, but policymakers remain optimistic that the pace of inflation will stabilize over the longer term. The Fed decided to keep its interest rate at 1.25% at their last meeting, and the expectations for another increase in the short term are very low. Nevertheless, FOMC members have different approaches towards the previously announced plan to increase interest rates 3 times this year. While some of them believe that it is appropriate to continue with the plan, others believe a cautious approach is more suitable and that the next increase should be postponed to 2018. Janet Yellen so far hasn't attempted to clear the air on this subject. Instead, she continues to support the idea of a gradual increase without mentioning any specifics. There will be 3 more Federal Reserve meetings by the end of this year. September the 19th to September the 20th, October the 31st to November the 1st, and from December the 12th to December the 13th. September and December's meetings will be followed with a summary of economic projections and a press conference by the chair. So, investors feel that if there are going to be any interest rate increases, it will happen at one of those meetings. In this atmosphere where nothing is certain and every comment from FOMC members or Janet Yellen are closely watched by investors, reports like NFP can have a major influence on the financial market. Having said this, the ADP or private employer figures were released today on August the 8th, a few hours before this webinar, and the figures were positive, well exceeding expectations. The forecast was that 183,000 new jobs would be created over the past month, but the official figure was 237,000. The value of the dollar since the announcement has increased. Nobody can say we don't keep you informed with up-to-date information. Useful strategies. The ADP figures to one side. News announcements of this nature can take on a life of their own with the amount of interest they receive. But it's important to note the danger and risks of trading on such events. Nobody has any idea what the NFP will publish, and even if they did, there is no way of knowing exactly how the market will price that data. Now that you've been informed, this is probably of primary interest to you. I will present 3 possible ways of how you can trade on high-importance news announcements like the NFP. Perhaps the simplest strategy for a less experienced trader is to use the news long-term strategy, which I will cover last. In fact, most successful traders take the news long-term strategy into account. That said, if you've never traded during one of these events, or if you don't feel comfortable taking on the risk that is inevitable with a high-impact announcement, you can use a demo account and sit on the sidelines. However, the non-farm payrolls is a great trading opportunity, and if you take note of these strategies, you stand a better chance of success. In any case, you don't have to use these strategies, or you may prefer to continue to use your existing trading strategy. That said, the slingshot strategy. This strategy looks to capitalize on the turmoil that may arise during an especially impactful or important event. In this strategy, the trader wants to look to go into NFP with their full position, so that if the volatility created around the announcement may be able to push their trade deeply into profitable territory, they can look to take advantage of that. The slingshot looks to scale out of winning positions as the trade moves in the trader's favor, and a variety of entities or entry strategies can be used to trigger the initial position. Support and resistance identification is a necessity before opening any positions. Traders can also take this a step further by looking to the hourly or 4-hour charts on MetaTrader 4, for example, to determine any trends that may exist leading into the announcement. This way, if the biases going into the NFP take place after the data is released, the trader can be on the right side of the move. Support and resistance is so important because that's the cut point a trader can use to close off the position if prices are going to move too far against them. Stops for long positions can go below support, and stops for short positions can go above resistance. So if either of these levels are broken, loss can be minimized. Traders are advised to investigate stop distance on their positions ahead of a data announcement as heavy as NFP. Spreads can widen quickly as market makers don't want to take a loss on the announcement. When spreads widen, stops can be triggered before prices begin trending, and this can be disastrous for the trader. The news reversal. Trading reversals are essentially dangerous in a normal environment, but when adding in the additional risk around news announcements, it can make this type of strategy high risk. Strong money and risk management is a requirement for success in these environments, because you can't be sure which reversals may follow through. Like the slingshot strategy, traders want to go into the release with support and resistance levels identified. Then they wait for the news. In the immediate period following the news announcement, a trader can watch prices to see if those longer-term support or resistance levels come into play. If they do, the trader watches to try to get an idea as to whether or not those levels are going to hold. Analysis of previous price action can be of huge help here. Traders want to see support coming into the market at these longer-term levels before triggering a long position with a stop below support. The key here is fitting in tightly so that if the reversal doesn't play out, the position is taken out quickly. But if that support level does hold, the trader can begin scaling out once the position starts moving in their favor in an effort to capture as much upside as possible. The use the news long-term strategy. Non-farm payrolls can be a game changer. A big beat or miss can stop a trend dead in its tracks and create massive reversals. But this doesn't happen every month. In many cases, enormous volatility is created around the announcement, with perhaps some slight follow-through thereafter, only to see trends resuming their previous trajectory. This can potentially be a huge opportunity for longer-term traders to pick up or add positions at a much more favorable price than they would have otherwise been able to. Let's look at an example for more clarity. Let's say that you are bearish on the euro dollar for whatever reason. Perhaps you're just a really big US dollar bull, or maybe you simply don't believe in the European economic recovery. Whatever the reason, you'll know that what you want to get is short euro dollar. But after spending a month confined to an inadequate range near long-term support, you haven't had a compelling entry opportunity in the pair. You can go into the NFP looking to do some bargain hunting. You can look at your longer-term chart to establish some resistance levels in which you'd like to sell if prices can make their way up there. The next step in the process is to wait for the news to come out to see if prices can move up into this resistance zone so that you can pass an order. Market opportunities. To be completely clear, a market opportunity is a one-page briefing containing market analysis, and our goal is to provide clients with a simple-to-understand opportunity to do well in the markets. Our senior account managers will pass on these trading opportunities to you, but of course it's up to you to decide whether you want to take up the market opportunity. Either way, we will provide you with the most important economic news and analysis, so you can make an informed decision about what to trade. As you might know, market opportunities are produced by our research department on a daily basis, according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis. That you can see on the right-hand side of the screen now. This section contains the pivot point, which is the recommended price for opening a trading position. What you can see in front of you is a sample of a market opportunity. Support and resistance levels for daily, weekly, or monthly terms, and finally profit or loss calculations are based on one lot trading volume. This is just an example of a market opportunity, and it's entirely your decision whether you want to take advantage of it. And now for our special offer. If you make a deposit within the next 48 hours, you can receive a balance bonus. If you deposit €1,000, you will receive a 2% balance bonus on a second time deposit. If you deposit €2,500, you will receive a 4% balance bonus on a second time deposit. Deposit €5,000 and receive a 5% balance bonus on a second time deposit. Deposit from €5,000 to €15,000 and your overnight interest rate will be covered for 1 month. Deposit $15,000 to $25,000 and your overnight interest rate will be covered for 2 months. Deposit $25,000 or more and your interest rate will be covered for 3 months. Of course, we at FullTrade will be following any developments that affect the markets very closely, so please do get in touch with the Senior Account Manager if you have any questions or want to take advantage of the trading opportunities that this event is certain to present. Our next webinar will be on the ECB Monetary Policy meeting on Tuesday, the 5th of September. Another important event that is likely to have an impact on your trading decisions. So please sign up for that webinar, as we'll continue to give you the very best quality analysis out there. Until then, goodbye, and please join us again at FullTrade soon.